Every startup has a beginning, but not every startup has the same ending. For founders and investors, the exit strategy is the finish line, the way they finally turn years of work, sweat, and risk into real returns. But here's the thing, there are a lot of exit strategies for startups. In today's video, we are breaking down every major exit strategy for startups, the good, the bad, and the ugly. But before we continue, what is an exit strategy? An exit strategy is simply the method by which investors and founders cash out their equity in a startup. Venture capitalists, angel investors, even employees with stock options all expect some kind of exit. It's not about giving up, it's about realizing the value you have created, and depending on your company's journey, there are several paths. First of all, acquisition. One of the most common exit strategies is acquisition. Acquisition is when a larger company buys your startup. This can happen for your technology, your product, your customer base, or simply your team. Think of acquisitions as the classic startup fairy tale. Build something great, get noticed, and sell for millions or even billions. The pros of acquisition: quick, often very profitable for founders and investors. Provides strategic resource and stability. Great for startups without IPO level scale. Cons: loss of independence. Product may get absorbed or shut down. Culture clashes can be tough. Then we have initial public offering. An IPO is when a private company lists its share on a stock exchange and sells to the public. It's the dream exit for many founders, the big league stage. Pros: massive capital raised, liquidity for shareholders, prestige and visibility. Cons: expensive, complex, and time-consuming, constant public scrutiny. Founders risk losing control. Think of IPOs as the marathon finish line. You need years of preparation, discipline, and a business model ready to withstand Wall Street. Merger. A merger happens when two companies of similar size combine to form a new entity. This is not about one buying the other. It's a partnership of equals, at least on paper. Pros: combined strengths and markets can create a stronger competitor. Cons: complex integration. Power struggles between leadership teams. Management buyout. In a management buyout, the existing founders or executive team buy back investors' shares to regain full control of the company. This often happens when the business is profitable but does not fit the hypergrowth model investors want. Pros: founders regain independence. Company continues privately at its own pace. Cons: requires financing to buy out investors. Can be risky if debt is involved. Secondary sale. A secondary sale happens when investors or founders sell their shares to other investors, like venture capital firms selling to private equity or larger funds. The company does not exit as a whole, but some shareholders get liquidity. Pros: early investors get cash out without waiting for IPO or acquisition, brings in new investors for growth. Cons: founders may lose friendly early investors, signals to the market that insiders may be cashing out. Private equity buyout. A private equity buyout is when a PE firm acquires the startup, usually later in its life cycle. The PE firm might restructure the company, improve profitability, and then resell it or take it public later. Pros: provides liquidity for founders and investors. PE brings operational expertise. Cons: focus on cost cutting and profit may clash with startup culture. Founders often lose control. Acquihire. An acquihire is when a bigger company buys a startup mainly for its team, not necessarily for its product. The product may even be shut down after the deal. Pros: founders and employees get jobs and sometimes bonuses. Investors get partial returns. Cons: usually smaller payouts and product vision goes away. Liquidation or shutdown. Not all exits are glamorous. Liquidation happens when a startup fails and sells off assets to pay debts. Investors and founders may get little to nothing back. Pros: clears obligations, allows founders to move on. Cons: investors lose money, employees lose jobs. So now you know about at least 8 major exit strategies for startups: acquisitions, IPOs, mergers, management buyouts, secondary sales, private equity buyouts, acquihires, and liquidation. Some are glamorous, some are painful, but all of them are part of the startup life cycle. The key is to plan ahead, because the choices you make in funding and growth will shape your eventual exit. If you enjoyed this deep dive, hit like, subscribe, and share it with your friends. And comment below, if you were building a company, which exit would you aim for? IPO, acquisition, or something else? Now this is the end of this video. Thanks for watching.